Hi folks, Pat Gage here. And on these videos, we're going to cover the mastermind calls, the commercial real estate mastermind calls that we hold bi-weekly. If you want to join these calls, there's a link right below me right here, and it's also in the description. We cover topics of buying properties. We cover topics of people who have bought properties and show us our process, show us their numbers. Love to have you on these mastermind calls. So again, click on the link below and we'll see you there. Thanks much, folks.
Your commercial space, you really can start to take advantage of some of the tax benefits of real estate. I get that often. What are the benefits? But now you're entering a realm that 1031s and cost segregations, a lot of times tax credits start to make those deals attractive. And I think and more on the single family is really a stepping stone, but I think everybody tonight's looking at the commercial and multifamily / industrial. At the larger deals, there's a lot of opportunity there, and especially as you become an active investor, really developing properties / renting it or selling it. That's really where I've seen the greatest amount of wealth creation throughout my career.
Gotcha. And probably what you do, and again, you're a member of a team, right? That when you get into commercial real estate, you've got team members. It's not just, you out there doing deals. You got the CPA, you've got your attorney, your syndication attorney, if you're doing that realm. So you're part of a team. So a lot of these, let's say, bigger deals, when you run the numbers, you're like, if they give you straight numbers, you're like, how does it work? Well, a lot of times it works because of what you bring to the table as far as, like you said, the cost segregation and different tax advantages that you can get with people to make these deals work or be better. Let's put it that way, right?
Yes. I actually spoke with somebody today that was working on a deal, larger commercial properties, and some, I guess, retiring investors that own the properties / seller financing in there. And we had really discussed even structuring the deal more equity position. And with real estate, we think of, I want hard cash, I want to sell, but there's consequences. Sometimes with real estate, I've seen deals structured that exiting partner or owner may get an equity position with a preferred return and return on capital, and then be able to structure it to really taxes because they actually have not sold it. And sometimes they still maintain equity position versus a debtor creditor position case scenario. They're not as protected had they sold. They're really, a lot of times you've got that investor, and a lot of people in the group will see someone selling a property, and it's just because they want to retire to Florida and they want their checks. How you structure that, sometimes if you can minimize that sell tax burden, your price deal is going to be able to structure differently.
That's why some of these deals that we're seeing,
the conversation today,
multifamily, when you see them selling, when you run the numbers, you're like, how does this even make sense? How are they even selling at this price, or why are they selling at this price? Maybe because some of the stuff behind the scenes that a person such as yourself, a CPA or in the tax realm, has made that kind of happen, right?
Yes, and many times there may be low-income housing credits, especially on the multifamily space. There's other opportunities as you for HUD guaranteed mortgage. There's investors that some situations are just looking for tax credits or that accelerated depreciation. On the multifamily, someone comes in and they're going to pour a bunch of money into a value add play, but a lot of that in initial investment is going to qualify for immediate depreciation under a cost segregation, and the way that the tax law is written as of today, it's, I mean, a great opportunity. Gotcha. And still hold a piece of the future appreciation and investment of that.
So when should somebody that's investing in real estate get you involved on the team? When's a good time? Is it tax time or is it before that?
So actually I like to get connect and usually early on and that we have that relationship, and I always encourage clients, contact me, anything we can do. It's easier to structure, try to pick it up after the fact, meaning this time of the year for 2020, there's not really much to do, and we can really be able to provide a lot of value and insight into a deal that you're working with, but it's tough to structure something you did last. So I really try to encourage communication with clients. And
okay, well, and that's good advice, because obviously, again, like I said earlier, you're part of the team that we do commercial real estate with and stuff. So that's awesome. And kind of a heads up, Frank and I know each other, so it's a little bit easier for us to chit chat, but I wanted to bring him on and kind of explain something. What he did is, I really want to talk about, and I'll spend the next couple of minutes here talking about this. He presented let's say a philosophy, right? Let's say a way of doing it's for developers, and what I did is I put together a slideshow here real quick to just kind of illustrate it, and I think it can work for commercial. Frank and I talked a little bit about this. We want to share this with you. And basically what it is if you, let's say you're a developer, let me do this. Let me share my screen, and then we can cover it that way. Hang on one second here. All right. Hopefully you guys and gals can see my screen. All right. Can you guys see my screen?
can now, yes.
Okay. Awesome. Okay. What this is basically I need somebody to do all these meetings. Basically, it's developer property. So it kind of what it is, if you have a house that's on land and you are going to basically, tear down the house, right? And just level the house and then put something else in its place. This process, which another friend of ours is involved with, which is very key to this, is so if you have a house, a couple houses that you want to demolish, what we do is obviously you would contact a person such as Frank here or a CPA. And then what we're doing, the difference we would do here is you would basically what we're doing is we're piecing out the house. The appraiser would come in and appraise the house pieces or the building materials, and help me if I'm saying this wrong, Frank, out like I've got here on this slide here. So the appraiser would give a value to each one of these pieces, the wiring, the piping and stuff like that, the kitchens. And again, a little bit different than you would do if you're, let's say, just tearing the house down. You have to take a little bit of care, because what we're doing is we're taking these items from the house, we're putting them in a shipping container, and then we're giving that to a charity that moves it on to the next. So stuff is not going to be destroyed. So this is where it kind of gets a little bit different than if you're just tearing the house down and, you got $15 an hour guys and they're just ripping the crap out of it. So there's a little care to be taken. But Frank and he introduced this to me, and it kind of intrigued me in the fact that you could have a house. And what you're really doing, folks, and correct me if I'm wrong here, Frank, is basically you're getting money appraisal. Let's say they get appraised for all the stuff in the house. You're going to tear the house down anyway, right? You're going to take the doors off, and you get an appraisal of $12,000 or $20,000. That turns into a tax credit on your tax bill. Okay, so
It's actually a, but which then go against your taxes.
Okay, can you say that again? Can you cut out? I don't know if it was mine or.
So it's actually a charitable deduction, and then there's some appraisal requirements, but effectively that deduction will be a deduction against your taxes, resulting in a tax benefit, so less out of dollar. Just clarifying, a deduction's in the tax realm different than a credit. So,
Gotcha.
but
Okay, thank you.
basically, and I think that the house that you're showing may not be a great example, but really houses, multifamily, I think since being able to, I think, get creative and think out of the box, because a lot of times you're seeing a property that you're going to send in the bulldozers and scrape it down to the dirt. There may be usable, or even in the commercial and office area of renovation and materials that care can be salvaged and are used. I think we were discussing a drywall demolition. Generally, that's not going to be usable.
And I like your idea of the office, the office space for the dividers and stuff like that. And again, it's something that was, Frank brought to me with our other mutual friend, Mark, and it was intriguing, the fact that, you're going to take this office space or industrial space and basically throw this stuff away, right? Why not get some credit for it? And then the other piece of this pie, which is our mutual friend, then you would donate it to a charity. Now, we have a charity, Mark is one of our mutual friends, that has this charity that is set up. He can do this in all 50 states. In fact, I probably should bring him on and explain, but he had a developer. They did this in California, and the guy knocked down 2 houses, and I think his total tax deduction, was somewhere in the range of $50,000 to $60,000 by just taking a couple extra steps of taking the care of taking the materials out of the house, put him into a shipping container like we have here. Taking care with this stuff, not just tossing them into a gondola, right? Now, obviously, you as the developer, investor, would have to pay for the gondola, have to pay for a little bit more care of taking the materials out of the property. But think of the benefit on the other end if you can get a tax, let's say, deduction of, $25,000, $30,000 that you can take this year, or whatever your tax situation is. So basically, this is kind of a neat way to do it. Even with smaller multifamilies, you can do it, because Frank and I talked about trying to do it on a commercial apartment building where you have you're not really taking the plumbing out, you're not taking really the wiring out. It's mostly the kitchen stuff. It really may not, we haven't proved it out yet, but it may not be, worth the cost. But again, if you're doing a total rehab, it may be worth looking into this process or this way of doing things to, help your bottom line. Is that about right, Frank? Did I capture that as well as I could have?
Yes. So I think the one example you mentioned, I want to say they probably had an extra 10,000 in cost that they incurred, but for them, it was really stuff that was going to end up in a dumpster. So yes, they incurred about 10,000 more in cost. And I think their actual donation was in excess of $300,000. So assuming,
Wow. Okay.
let's just say, if you look at it just from the true return, they might have had an approximately $60,000-$70,000 tax reduction that they had to pay out of pocket. Again, for all of you on the call looking at structuring deals with partners, be a situation that your partner comes in and can utilize it on a syndication deal. Sometimes you have other investors that when split those accelerated depreciation or contributions or credits. It can be a little bit more to make the deal sweeter. And again, not necessarily going to work on every deal, but another opportunity, as I discussed earlier with the seller financing versus equity, out there. That's why, even back to what you were saying, Pat, about when to work with your profession, say early on, because then we can identify if there are opportunities like this that we don't pass up.
Yeah, definitely. I thought it was intriguing enough. And again, like I said, we've got all the different parts in here, obviously a tax credit. And then I also did of an apartment building, and Frank and I had talked about that, where it'd probably have to be a pretty good size rehab of an apartment complex. Is obviously we're not tearing the property down, right? So drywall is not worth much, unless you have old copper wiring. But this is just one little, let's say, process or system you could possibly use during this. But again, if you're doing multifamily or residential obviously works better, because if you're tearing the property down, obviously the lumber and the wiring, all that stuff can be appraised, and you can put it and do it that way. And the biggest thing is, one, Frank works with the charity, which is Driving Successful Lives, and they take this storage shipping container and take care of the building materials and give you a document showing that you donated it to a charity. So this is not stuff that's going to be thrown away. It's stuff that'll be used. Right now, I guess they're shipping them to a different country. So the doors, the wiring stuff is being shipped to a different country. So it's not just being thrown away, which is good, obviously, for the environment, and also good for your business plan, where you can say, hey, listen, we're using this material. Somebody in need is going to get it. So, but does anybody have any questions that we can answer fairly quickly on that? I don't want to. What I would like to do first, hang on one second before I ask that question. If you guys would put your contact information in the chat, okay, and Frank will put his in there too. Reach out to him, and then if you're interested in sitting further and talking about this, again, we have all the contacts for people to get to do this. Reach out to Frank, or you can reach out to myself, and we'll set up a conversation and see, because each one of these is going to be different. Obviously, if you're a multifamily, we got to take a look at, is it going to work for you, depending on the amount of rehab that you're going to do and the number of units, and stuff like that. So go ahead and put your contact information, everybody, into the chat, and then that's where we'll get contact with people during that, and then we'll go to our breakout rooms here. But does anybody have any quick questions about what I covered here? No questions. Goodness gracious. Okay, let's see here.
And I think this is really one of the tools in the investing arsenal of rehab and developing the deal that, again, not always going to work, but is it going to be a cost segregation or other opportunities there? And really the biggest way to be able to structure a deal that's going to work out for you and your investors, especially as you work with outside investors, making a deal that appeals to everybody.
Exactly. And again, it's just another one of those tools in the tool belt, right? That it may work or may not. If let's say that you're scraping the land anyway and putting up a multifamily, and that house is there or that building is there, and you can gain, let's say, 5, 10, 50,000 new dollars in tax, and again, each person is different. So it just thing, but I wanted to share that with you and kind of give you an idea of kind of the possibilities that are out there. It's not for everyone, but at least maybe it'll be, somebody can use it in some way if you're still in the residential. We know it works on residential. We still have not given a test case of multifamily, but we know it works on the residential side. So, all right. Does anybody have any questions before we? Okay. Frank, do you have anything else? What else would you like to hit on with this, or other tips you can give us?
Really, I think just definitely reach out. Real estate is, each deal and each piece of property is unique. That's the beauty of real estate. Even that building, the way I look at that building is going to be different than what Pat's going to do with that building. And a lot of times I've worked with people that have taken a building that one investor has either done well or bad with, and the other hits a home run the other direction. So always feel free to reach out, but definitely I think everybody's on the right track being here tonight, and really appreciate having the opportunity to talk about this.
Well, we appreciate you coming on. I appreciate your information too. And again, if anybody has any further questions about this, or CPA, Craig, you had something, sir?
Yeah. I have no real experience with what you guys are doing. I used to do rental properties, just small single family deals. And I'm kind of wondering what your thoughts are on the emerging sector. I guess, and it may not even be, it's just my perception is commercial property just doesn't need to be here anymore. So it would seem it would have to get converted into residential, or eventually I just can't see the commercial buildings that are here are even needed anymore. So what will they get converted to?
Are you specifically talking like office buildings or industrial? I guess which one are you talking that won't?
Well, it would seem to me that with everybody working at home, there's going to be a glut of commercial buildings.
Yeah, that's a good question. What I know that's sometimes what is happening in the market, I've heard, is like malls and stuff like that are being converted into distribution centers, which again is still a commercial. Now the office building, that's going to come back. It's probably not going to come back until about a year, 2 years from now. But there's always going to be, I think, some sense of an office space, or either more of a community space, more so than you have an office. It's like a shared desk. I see that happening a lot. I know some companies that I've known, they're trying to, get their people back, but it's more in a shared workspace, but yeah, the office spaces and obviously the retail is a little bit hurting now because obviously nobody can go out of the house, right? But retail will come back. I mean, there's some people, like cars, it's very hard to buy a car as much as we'd like to. And worked on projects where we tried to sell cars online. It's hard to do that, without, taking the test drive or seeing the car. So those will slowly come back. Office space these companies may just say, why are we spending all this money on not only, the building, the taxes, the maintenance,
I would be,
all that kind of stuff, and say, okay, we're spending, $5 million a year to have, our 3,000 people here. We've learned the productivity when people are working from home now, because they've gotten so accustomed to it, hasn't really dropped that much. In fact, the teams that I manage, the productivity has gone up because people are working probably more than they would because they're at home, right? And we don't condone that, but that's what happens. So that's a good question. But I mean, as far as industrial, and retail and stuff like that, you're going to see the malls that were struggling before probably fail, but they're going to be turned into a different use, like hotels. I know some people that are actually going after hotels right now to turn them into apartments. Now, you know, it's not every hotel, right? It's not the flat ones from the 70s that, you know, you pull up. It's probably, so each one, or they'll just get dozed and something else will go in. So, I mean, I don't see it ever going away completely, but I mean, there's gonna, you know, it's the wheat from the chaff, I guess, as they say, just like when, you know, Netflix, you know, all of a sudden Blockbuster went away and, you know, Family Video went away. That just happens, but I don't see them totally going away. But does anybody else have another opinion on that? I mean, I don't want to, you know.
Like you say, the one thing we can always count on, and that is change.
Yeah, yeah, that's true. That's true. Yeah, I mean,
I could almost envision like the humongous office buildings that are no longer, just turn them into an actual community. But like time will tell.
Yeah.
I mean, as I look across the world, I see that's what's happened other places. That they actually built an office building to build a community.
Yeah.
Micro businesses and your apartment and your foods, whatever. You don't have to hardly leave your building.
Yeah. Yeah, that's where a lot of office spaces were, like the companies I work with are for. Yeah, a lot of them you don't need to leave for lunch because they got everything there. They got kitchens, you know, Google has dry cleaning, everything. But that's I see that happening more too. But again, you never know. That's a great thought. Awesome. Okay. All right. Well, anybody else have any questions? What I'm going to do now is I'm going to break you guys and gals out into breakout rooms. We'll have about 3 to 4 participants per room. And this is a chance for you guys and gals to network with each other. You know, I'm in Michigan. I know a few guys here on the call are from Michigan. Don't know where everybody else is calling from, but let me get this set up here, and we'll break it out here in a second here.
I have to leave 7:40. Is it all right if I do my Zen meditation?
Yeah, we're gonna go. I think we're gonna go. Let's say 10 minutes. 10 minutes a turn here. So if you have to leave early, and that's a great comment, thank you, Craig. If you have to leave early, just go ahead. We're gonna do them for 10 minutes, and then we'll redo them again. We'll shuffle them around and see how you can meet some other people. All righty. All right, here we go. You'll be whisked away to your next. Okay. There you go. I think it worked, hopefully.
I'm not feeling the whisk.
You're not feeling the whisk yet.